presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compac Market Wrap YouTube update for January the 13th, 2026. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, remind all of you to click on the subscribe button so whenever I do an update, you'll be notified and you can watch it at your convenience. Also, if you need help with your portfolio, send me an email or give me a call at invest@compac.com or call at 800-388-9700. Start with the numbers. Good week last week. 1.58% was higher for the S&P 500. We saw the NASDAQ also up 1.88%. We saw the Dow up 2.34%. So a good week overall to start. And as the first week of January goes, so does January. And so as January goes, so does the rest of the year. But it will be volatility. On Friday, we did get the unemployment data. A little bit less than expected. 50,000 jobs created. A little bit less than what was expected. It was about 75,000 jobs were expected to have been created last month, but it was a little bit lighter than that, but not much off. Market was sort of okay with it. Over the weekend, we got news that the chairman of the Federal Reserve is being investigated for criminal overruns on the building that they are redoing for the Federal Reserve. So that creates some anxiety in the market. Should have been a big negative. The market initially started out Sunday evening when the news came out. The futures were down dramatically. But by the time the market opened yesterday morning, the market had come back up. And as you've heard me say over the last 30 years, whenever you get bad news in a market, and the market sort of brushes it off, disregards it totally, watch out for the market to the upside. We are pulling back a little bit today, but I still feel longer term, I'll show you the targets. Last week, the best sector was consumer discretionary. It was up 5.8%. Utilities were the weakest sector. Energy, technology was flat for the week. So we are seeing a shift from a lot of the technology still doing very well, the Mag 7 as they're called, but we are seeing a broadening out of the market, and some of the other stocks, the Dow 30, as I mentioned, was up 2.3%. Oil continues to drift in the mid-50s, no big change. Interest rates the same, no big change on the 10-year from 4.19 to 4.18. So just about unchanged for the 10-year treasuries. Looking at, there's a lot more activity expected in the first quarter of this year. We saw last year activity it was up from just about the highest we've seen, about 2.7 trillion, and that is the same expected for 2025. So a lot of mergers and acquisitions, a lot of companies buying other companies, and that sort of deals going through. As I mentioned, non-farm payroll rose, but we saw the JOLTS report, what is the job openings, they are down. So I think the labor market is about just going back and forth, not going anywhere at all. But as long as it does not break to the downside, that would be a big negative. But by the time we find out that unemployment is going up, usually the economy has already slowed down dramatically. This week we do get a lot of data. We get the CPI data up 0.3, about the same as last month. We get retail sales down slightly, up from the previous one. We get the PPI about a little bit lower than what we had the previous reading. Expectation is 0.2. So we do get some interesting numbers, especially on inflation this week, and we'll have to watch those. Looking at technically, we made the high right here, the third wave, fourth wave pullback we had here. Now the fifth wave target is still around 71.75, 71.5 is what I'm looking for, 71.75. We are today trading around 69.5. So we still got about a couple of hundred points on the upside. 3-4% maybe is the upside target for the fifth wave. This is a target right here, and the market is right here right now. Today, as I mentioned, down slightly, about 1/3% as we're going into the close. Weekly, still looking for higher numbers. Target still, if we can get above 71.75, then the target becomes somewhere around 7,300. So we'll have to wait and see. NASDAQ, also similar picture, still to target right up here, 25.2. We're sitting at 23.6. So another 1,500 points or so that we could get on the upside for the fifth wave high. This is wave 5, but it should head up here somewhere over the next weekly charts. The same, still showing the same target. Interest rate stuck right here about 4.2, and this is the top of the range that we've seen to about 4%. If we do break out and we get to about 4.23, that's okay. But if we get much above this number right here on the 10-year, that'll show us a breakout to the upside, and then we could be headed towards here, which is much higher rates at 4.5%. And that would definitely get the market a little bit worried. Gold continues to rally, as we saw a lot of anxiety over the Fed chair. If he's going to be kicked out, is it going to be replaced? He came out with a defiant statement on Sunday night that he's not going to be intimidated. But the President of the United States is the President of the United States, and taking on the President, I think the Fed chair does not really have much. But a lot of the senators and a lot of the people said this could be. I think the biggest thing would be how the market reacts. The market starts to crash because the Fed chair is going to be replaced by somebody that'll bring rates down too much. Bringing rates down is a two-edged sword. It could be great for the economy. More money is flowing into the economy. But as more money flows into the economy, it creates demand, and demand creates inflation. If inflation starts to take off again, then the Fed will have to raise rates dramatically to clamp down on inflation. So bringing rates down too much could be a very short-term boost for the market, but in the long term, it could be negative if inflation takes off. Then the Fed would have to raise rates, and really bringing inflation down, one of the ways to do it is put the economy in a recession, and that is not good for the stock market overall. So we'll have to watch what happens over the next few months as the new Fed chair is going to be nominated. Then it has to go through the confirmation process, and who the next chair is going to be. That's going to be a question. What are the policies going to be? High yield bond market seems to be breaking out to the upside, which is a good sign. And as long as we can get above here, break out to the upside, that could be very good. I'll give you a projection for the HYG. We're about 81.3 today. This is the 20-day moving average. This is the 50-day moving average. This is the 200-day moving average. So HYG, which is the high yield bond market, is doing well, and that is one of the indicators that we watch carefully. Those are my thoughts. Those are my observations. Again, make sure you subscribe to this channel so whenever I do an update, you will be notified. If you need help with your portfolio, send me an email at invest@compact.com or just call 800-388-9700. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.